And we're back. Looking at the different type of stocks that a company may offer. The most common is called common stock, but there's another group of stock known as preferred stock. When you purchase preferred stock, it gives the owner preferences in the payment of dividends and an earlier claim on assets than the common stockholders. So when you are preferred, it means that you have certain rights over the common stockholders, but you also give up a very important right, which is the right to vote. Preferred stockholders do not have the right to vote on key issues. Preferred stock can be callable, which means that that stock can be called back or paid by the company at a certain time. It can be convertible, which means that with preferred stock, it can be converted into a different type of stock or security, such as common stock or bond. It could be cumulative, which with preferred stockholders receive a dividend as a percentage of the stock, what we call par value. When it is cumulative, it means that if a company does not pay out dividends in the current year, when they do pay out dividends, they must pay for the current year as what we call any dividends in arrears. Okay? What about bonds? Companies can issue bonds as well as a way to raise capital. Now, bonds are different from stocks. We call stocks equity financing, which means you're selling ownership into your company. Bonds is what we call debt financing because with bonds, the bonds must be repaid at some point in time. Okay? So let's look at the language of bonds. A bond, a corporate certificate indicating that a person has lent money to a firm. So when you buy a bond, you are loaning money to a firm. The principal is the face value on the actual bond. So the bond may have a face value of, say, $1,000. Maturity date is the exact date the issuer of the bond must pay the principal to the bondholder. So you may buy a bond today. That bond may mature in 1 year, meaning that on the maturity date, the principal amount is paid to the actual bondholder. Now, there are different types of bonds. There are U.S. government bonds, bonds you can buy from the government. There will be called T-bills or Treasury bills, which are bonds that mature in less than a year, typically a denomination of 1,000. There's a Treasury note, Treasury bond. So these are all bonds been issued by the government. There are municipal bonds, which are bonds that are being issued by the actual state or city. And then there will be called Yankee bonds, which are bonds issued by foreign governments payable in US dollars. And bonds are also issued by different types of corporations. Now, when there's a bond, there's interest that has to be paid to what we call the bondholder because bonds are a form of debt. All right. So when you issue a bond as a company, the payment to the issuer makes the bondholder for use of the borrowed money. So in essence, when a company or the government issues bonds, they have to pay interest to the bondholder. The bond interest is sometimes called the coupon rate. So let me explain that. When you buy a bond, that bond will have a rate of interest, say 5%, which means that 5% of that face value is paid to the bondholder as interest. The bond interest rates can vary depending on the government's rates, the economy, and the reputation of the issuing company and other company rates. So what we're saying here is that depending upon what we call the prime rate, that is the rate that the government loans monies to financial institution, depending upon inflation, depending upon the company's reputation, because bonds are rated just like students. Bond ratings go from an A rating down to a D rating. It depends upon how stable those companies are, meaning have those companies paid back the amount to the bondholders in the past when they were due. Bond ratings, as I mentioned, assess the credit worthiness of a corporation's bond issues. So all of these factors will impact the interest rate chosen for that bond. So as I mentioned, here are the different rates. There are three different companies that rate bonds: Moody's, Standard & Poor's, Fitch Rating. And again, it's just like grades. If a company is strong financially, they may have a AAA rating. If they're poor, meaning that there's a risk, which means they probably have defaulted or not paid a bondholder back in the past on time, they may have a C rating. And if they're not strong financially, they're not stable financially, they may even have a D rating. So the lower the rating, the more risk comes with the purchase of those bonds. What are the advantages of a bond to bond? I'm glad you asked the question. So bondholders are creditors. They're not owners of the firm. So when you issue bondholders cannot vote on corporate matters. The interest paid to the bondholders is tax deductible for the firm that issued those bonds. Bonds are a temporary source of funding and are eventually repaid. So a bond may mature in 1 year, 5 years, 10 years, but at some point, bonds must be repaid on their actual maturity date. Now, some bonds are callable, which means those bonds can be repaid before the maturity date at the option of the bond issuer. This is some good stuff, isn't it? Yes, it is. Now, there are some disadvantages of issuing bonds. Bonds do increase your debt and can affect the market perception of the firm. So bonds are shown as a liability on your balance sheet. Paying interest to the bondholder is a legal obligation. So when you issue bonds, you are required to pay interest to those bondholders. If not, the bondholder can take legal action against those companies. The face value of the bond or the principal value of the bond must be repaid on the maturity date. So if a bond has a face value of $10,000 and it matures in 5 years, on that date, you must pay that face value to the actual bondholder. Now, just like stock, there are different classes of bonds that we call unsecured bonds, and you have secured bonds. If a bond is unsecured, also called a debenture bond, it is not backed by specific collateral, meaning that if the bond issue goes into default, they do not pay the money owed to the bondholder, there's no collateral for the bondholder. They must take that company to court in order to try to receive the money owed to them. But if a bond is secured, there is collateral such as land or real estate to protect the bondholder. In this case, if there's a default, the bondholder has the right to possess the collateral such as the land or equipment that's used as collateral to protect that bond. Okay? There are some special bond features such as a sinking fund. This is a reserve account in which the issuer periodically retires some part of the bond principal prior to maturity so that enough capital will be accumulated by the maturity date. Let me explain that. Let's say a bond matures in 10 years. Well, every year the bond issuer will put funds aside into a reserve account known as a sinking fund so that when that bond matures 10 years later, they have enough money set aside to pay the amount owed to the bondholders. Callable bonds. or bond that permit the issuer to pay off the principal before it is due. So if a bond matures in 5 years but is callable, they may pay that bond off in only 2 years. Why would you do that? Well, because a bond is debt. And if I have the money to pay off my debt, why would I pay it off early? Okay? If a bond is convertible, it allows the bondholder to convert their bond into shares of common stock for that same company. So, for example, if you purchase a bond from AT&T that is convertible, you will have the right to convert your AT&T bonds into AT&T stock. Now, there will be some type of specifications about that, and that will all be shown in the actual bond contract. How investors buy securities. So what you've seen on the slide that showed the New York Stock Exchange, those individuals are known as stockbrokers. They are a registered representative who works as a market intermediary to buy and sell securities for clients. So when you want to buy stock, you can hire a stockbroker to purchase stocks for you or security. But now we have a lot of online brokers as well. So Charles Schwab is one of the most common online trading services that allows you yourself to purchase stocks and bonds. So I recommend that each and every one of you at least set up an account through Charles Schwab because it's free and just learn more about how do I purchase stocks and bonds of other companies. So again, online brokers can charge zero trading fees. So yes, when you're buying stocks through Charles Schwab, there aren't any trading fees. Now, there's caution you if you purchase certain type of stocks and bonds that are considered to be special, there could be some fees, but for the most part, you're not paying any fees when you're trading stocks and bonds through these online brokers. Okay? How do I know how to choose the right investment strategy? Well, there should be 5 criteria you're going to take a look at when selecting your investing option. First, investment risk. What is the risk that I could lose my investment? Are you willing to take on more risk? If so, you might buy stock. If you want to be more conservative, you may decide that you want to buy bonds. Okay? Yield is what we call the return on your investment. Am I looking for a high return on my investment? Of course you are. But at the same time, sometimes the higher yield comes with more investment risk. Duration. How long do I want to wait for this investment? Is this a 1 year investment, 5 year investment, 10 year investment? That can impact your investment strategy. Liquidity. How liquid are my investments? So if you buy a bond that matures in 10 years, you have to wait 10 years to receive your investment back. But if you purchase stocks, you can sell stock on any given day and receive your money back quickly. Tax consequences. So tax consequences, the investments or the deductions taxable. For again, if you pay out dividends, dividends are not tax deductible, but if you're paying out interest to the bondholder, the interest is tax deductible. Things to do before making your first investment. Take an investing class. We have a class here called Personal Finance that will teach you more about how to invest. You can attend a conference, head to the library and get books about investment, consult with experts, have a diversification plan, meaning that you want to diversify your investment options and look at the historic information about stocks before you decide to invest in those companies. Okay, so stay tuned for the exciting conclusion of our chapter 19 video.